First of all, I would like to welcome you to the live class on marginal costing. In the previous class, we have already discussed what is the meaning of marginal cost and what is the meaning of contribution and all. But still, for today's class, I am again repeating the few points which we have covered in the last meeting. So, dear students, before understanding anything, you should be able to understand that in marginal costing, what we are supposed to do. In the marginal costing, we are supposed to calculate the profit, and for calculating the profit, this is the pro forma that we are going to follow for calculating the profit. Now the question is, sir, for calculating why there is a need for marginal costing? The reason is the another name of the marginal costing is variable cost. And you know very well that the nature of variable cost and fixed cost. As the variable cost varies as per the volume of production, but per unit it remains same. And as far as fixed cost is concerned, fixed cost in total it remains same, but per unit it varies. While taking the decision, the fixed cost cannot be taken into account because it never changes. But marginal cost changes as per the change in volume of output. So that is the reason marginal cost should be taken into account whenever we are preparing the profit. And therefore, to make or buy decision, the managerial decision regarding continuing with the same product or invention of the new product or introduction of the new product line batch or any of the job, for that purpose, marginal costing is used. Here, as you can see, this is the pro forma of marginal cost sheet or the marginal cost. As per this pro forma, first we should take into account the total sales. And from this sales, we have to minus the marginal cost of sales, that is variable cost. So variable cost consists of opening stock because the stock changes as per the volume of change in production. We have to again add the production cost because production cost is increased as per the increase in production. We have to minus the closing stock. Then you will get the marginal cost of production, that is variable cost of production. Once you get the total variable cost of the production, from this variable cost, we have to minus the selling and administration and distribution cost. So all these three costs, they are variable in nature. So variable means the another name for the variable cost is marginal cost. So if you minus from the sales variable cost, you will get the marginal cost of sales. So once you get the marginal cost of sales, from the sales, if you minus the marginal cost of sales, you will get the contribution. It means contribution is that proportion which will cover the fixed cost and profit. The reason is from the sales, we have to minus the two types of cost. One is variable cost and second is fixed cost. So from the sales volume, if we minus the variable cost, whatever is the proportion left, that proportion will be called as an contribution because something has been contributed extra rather than the variable cost. So this extra contribution will cover this fixed cost, and therefore from the contribution, if we minus the fixed cost, we will get either profit or loss. So that is called as an marginal costing profit. So this statement every student has to learn, and the simple way to learn this statement is you have to just remember S, that is sales minus variable cost is equal to what? Contribution. And contribution minus fixed cost is equal to what? Is equal to profit or the simple income statement of marginal cost, which we can take into account for calculating the various numerical questions. Now moving on to the next slide. Here in the marginal costing, this term has been defined, which is known as an contribution. So in today's lecture, I am going to cover the term contribution. Basically, the term contribution means it is the term given to the difference between sales and marginal cost. So contribution means the difference between sales and marginal cost. Marginal means variable cost. Variable cost. So the difference between sales and variable cost is called as an contribution. So sales minus variable cost is equal to contribution. The analysis of marginal costing depends a lot on the idea of contribution. The reason I will explain in the next slide. Actually, this technique, the efforts are directed only to increase the total contribution. See, if you increase the volume of sales, the variable cost will increase. But as the sales increases, your contribution will also increase. And if the contribution is increases, fixed cost remains same. And if the fixed cost is remaining same, then from the contribution, if you minus the fixed cost, the maximum will be the profit. And therefore, contribution is a term which defines the surplus that remain after variable cost of sales is deducted from the sales. So therefore, here you can see marginal cost is equal to variable cost. Variable means direct material, direct labor, and direct expenses. Why we have taken this direct material, direct labor, and direct expenses? The reason is all these three elements of cost, they are changing as per the change in volume of production. And that is the reason they are coming under the preview of variable cost. And these are the direct overheads and the expenses. Plus, we have to also take into account the variable overheads. Variable overhead means here you have to take factory overheads, then administration overheads, and selling and distribution overheads. So these are the overhead which are variable in nature. So if you just make the total of all these things, and if you minus from the sales minus variable cost, the difference that you will get is considered as an contribution. It means from the sales, suppose we minus the variable cost, the extra proportion which is left, that proportion will be called as an contribution. Now, the next term in the marginal costing is break-even point. See, the very interesting name is given over here, break-even point. See, here even, it is most important, break-even point. The break-even point is the level of activity or the sales at which company makes, this is very important, neither profit nor losses. It means that break-even point, it is a particular level of activity of any of the business concern. At this particular level, business gets neither profit nor losses. It means business is in the equilibrium position. It means the total sales is equal to the total cost of the company. So therefore, every business, before carrying out any of the production activity or any of the business activity, they should be able to know what is the break-even point of the particular activity or the product or services. And therefore, sales revenue exactly equals to the total cost at this level. Therefore, sales volume at which break-even is indicated by the break-even point, the term number of units sold, or in the terms of value, it can be expressed as sales minus variable cost is equal to fixed cost plus profit. See here, sales minus variable cost. What is that? It is contribution. And fixed cost plus profit is equal to also contribution. It means if contribution is equal to contribution, it means there is no profit, no loss. Since the break-even point, the profit is nil, here sales at the break-even point minus variable cost is equal to fixed cost. The reason is sales minus variable cost is equal to what? Contribution. And if your contribution is equal to the fixed cost, it means from the contribution, if you minus the fixed cost, the result is zero, that is nil. It means this is the point at which the sales is equal to total cost. It means that the break-even point is minus variable cost is equal to the fixed cost. And therefore, nil or cost, and therefore sufficient amount of contribution is necessary to earn to cover the fixed cost before any profit can be earned. If the level of actual sales is above the break-even point, then profit will be earned by the company. Or you can say on the other hand, actual sales, if it is below the break-even point sales, then there will be a loss. And if the actual sales is above the break-even point, then the company will be in profit. So let's understand this chart, the break-even point. See here, break-even chart. On the y-axis, sales is mentioned. On the x-axis, the quantity of sales is mentioned over here. You can see this horizontal line indicates fixed cost, which is fixed. And above this fixed cost, this line goes, it is known as a total value. And from the center point, this line indicates the total sales. So here, as fixed cost is fixed and total revenue or the total value, here it is indicated by this line, and this line is indicating the total sales. So fixed cost plus this variable line, variable expenses line. So these are the lines, and this is the intersection point. Here you can see this is the intersection point. It means this is the point at which, here you can see total sales here is equal to total cost, fixed plus variable. See here, it is a fixed cost and this one is the variable cost. So fixed cost plus variable cost, total cost is equal to what? It is a total sales, and therefore this is the point of break-even point where there is no profit, no loss. And whatever is this portion indicates profit, because if the company gets the sales more than this point, then whatever is the extra revenue that is being incurred, that will be contributing to the profit. And whatever you earn below that line, so this is called as an loss. Are you getting my point? And therefore the difference between these two is considered as an profit. And here you can see from this line to this line, this portion is the proportion of variable cost because it is beyond the fixed cost, and this portion is the fixed cost portion, whether you should continue with the production activity or not, but still this cost is going to be incurred in future. So this was the explanation of break-even chart in graphical mode. Actually, the break-even point is totally depend on few assumptions. What are the assumptions? Here, the first assumption of the break-even chart is, as the sales increases, variable cost also increases. The second assumption is fixed cost always remain fixed. It never changes as per the increase in or decrease in volume of activity. So these are the few assumptions of the break-even chart on which the entire break-even point is being totally based. Now the next terminology in the marginal costing is PV ratio. Basically this profit volume ratio is known as PV ratio. So profit volume ratio means contribution for every 100 sales value. It means for 100 rupees, how much is the amount of contribution? It is always calculated on the percentage basis. So therefore, contribution from the sales is expressed as sales value percentage. Therefore, this is known as an profit volume ratio. And the relation contribution and sales expressed in percentage. The another thing is change in profit due to change in volume is reflected by this ratio. Sometimes if the profit is being changed due to change in sales, then also PV ratio can be calculated, and therefore PV ratio is equal to this triangle indicates change in profit divided by change in sales divided by change in sales. So this is the another formula for calculating profit volume ratio. When the change in profit and the change in sales is given, so at that time with the help of this formula you can calculate the profit volume ratio. Here you can see the one example is being given over here. the size of the sales is 100, then profit volume ratio of 60% means that the contribution is 60. How contribution is 60? Because if sales is 100 at that time, what is the formula for PV ratio? PV ratio is equal to contribution upon sales into 100. So here the amount of contribution is not given. The amount of sales is 100 multiplied by 100. And what is the PV ratio? PV ratio is 60%. So for percentage, 100 is cancelled. So for this 100 is cancelled, and therefore PV ratio remains 60%. It means your contribution is 60 rupees as compared to your sales. Now the next point in the marginal costing is margin of safety. So this is the most important and the decision making factor in the marginal costing. Margin of safety means the difference between the total sales and the sales at the break-even point. See, these two things are important. It is the difference between total sales and the sales at break-even point. It means total sales minus BEP sales. Now you know break-even point sales means these are the amount of sales where there is no profit, no loss. If your total sales is more than break-even point sales, this is your margin of safety. It means you are in profit. But if your total sales is less than break-even point sales, then at that time your margin of safety is in negative mode, and therefore you may be facing a losses. To increase the margin of safety, company should take into account or keep its break-even point lowest level and should try to maintain the actual sales at the highest level. So therefore, by controlling the fixed cost or by resorting to sales policy or by reducing the variable cost, this can be done and margin of safety can be increased. Reproducing the profitable products after discontinuing the unprofitable ones can also help to increase the margin of safety. And here the formulas are mentioned over here. Margin MOS means margin of safety. It can be calculated in units and it can be calculated in rupees also. So formula for calculating margin of safety in units is equal to sales unit minus break-even point units, and for rupees, sales in rupees minus break-even point in rupees. So this is the very simple formula for calculating margin of safety.